irrespective of the asset you trade, anything trading related is a discipline that requires deep understanding of both time and price. So in order for you to actually be successful as a trader, you need a solid grasp of how these two elements interact with one another. Time and price are actually both critical elements of trading, as they provide valuable information that can be used by you to make your decisions. You want to know when to buy, you want to know when to sell, you're in a position, you need to know when to exit. Time factors can make you make decisions in the market that will either protect your capital or grow your capital, whatever the case may be. On this first part of our lesson, this mentorship, what we'll be focusing on is the essence of the different time frames. We want to understand the smart money perspective, the institutional perspective. So what do they do there? We want to be smart traders, right? You want to make money because you want to imitate the smart money institutions. You want to do what they do and how they do it. So we will focus on the essence of the different time frame and see how this smart money, how they actually implement these time frames, and we will use them to actually make our trading decisions. Now, the first thing you want to understand is, in its default state, price action is fractal. What do I mean? Whatever price pattern you see in maybe a daily time frame, that same pattern can exist in a time frame lower or higher than that initial time frame you saw it in. So for example, you can see all of these movement, these bullish movements. Let me put a marker somewhere. You can notice this whole bullish movement from November 4th. Let me navigate to another time frame. Fine. This is the same thing we have. This is November 4th, 2022. Look at the price pattern. It's the similar price pattern. They are both bullish price patterns from what we see in the 1 hour time frame and from what we see in the daily time frame. Now let's begin. Let's break down the time frames from the highest, which is the monthly time frame. So what do we do with the monthly time frame? What do the smart money do with the monthly time frame? What do the big investors do with the monthly time frame? This is what will frame our idea to give us the concept of what we ourselves will do, because we want to mirror these profitable ones in the market, so we'll be able to make decisions in the same fashion which they make them and be profitable. So the monthly chart has the most significance to analysis. Actually, it provides a macro institutional bias, the bias in the biggest of its form. This is where the institution they operate in, and it has the largest of accumulated volumes. So if you wish to view, please mute your microphones. So if you wish to view the market from a long-term perspective, the monthly charts, for example, I want to see the whole of 2022. I don't need something else. I can just do that from the monthly charts, count the last 12 candles. I know that is the whole of 2022. So looking at the market from a long-term perspective, I'll be able to know what the last trading year was like. So this is, let me mark from January 2022, and then you give your quick judgment by yourself. 21, 22, fine. So this is from January 2022. Now, from what you can see, what trend will you judge 2022 to be as? What kind of trend do you see in 2022? Anyone? Anyone? Unmute your microphone and speak.
Downtrend.
Sorry?
Downtrend.
Fine. It was bearish. Now, it's so simple for you to actually see the institutional order flow, what the big boys are doing, what the institutions are doing, just from your monthly time frame. So sometimes we easily get lost in the noise of the lower time frame, not literally noise, it's fractal, we can see the same information across. But sometimes because we expand the information too much, we get lost. So several times you might see people trying to station themselves in a long buy position in this kind of markets. So once you zoom out and watch the monthly time frame, you'll be able to clearly see what the institutions are doing, because the monthly time frame will provide you macro institutional bias. So without anyone convincing you or telling you anything, you come into this chart and let's say maybe at this month, what month was this? Expand this a bit. Fine. So let's assume last year you came into the market on July, and then you've seen what the whole year has been doing. You don't need anyone to convince you that this market is going to buy right now. Buy it. Rather, you see the institutional order flow by yourself from the monthly perspective, where the most volume resides. So the most volume in this fiscal year has been on the sell side. So you know you do not want to counter the institutions as a smart trader. So when you look at this and maybe you want to position yourself in a long-term trade, you know, buying in this current market any of these months would have been a wrong option. It would have taken you several months for you to even return to break even. Now, after talking about this monthly analysis, monthly time frame, the function of it, I want to talk about how to use the monthly open. When we analyze the chart and determine that our monthly time frame is bullish, as traders, what we want to do is to look for buying opportunities around or below the opening of that monthly time frame. What do I mean? Let me break that down. Now, this has been 2022. It has been selling. Now, looking at this chart with the way it is, what will be a convincing factor to you that this current chart is a buy market? What will convince you? If you look at this chart, look at the current month and the past 3 months or the past 4 months. Notice how the price is moving. Look at this November's candle. Look at the range of it. Look at the impulse. And then look at the next month, December. It was more like a continuation of the impulse. Now, since you've seen this kind of impulse, and where you're seeing this from is from the monthly time frame, you want to understand that this is big volume. This is interest to buy the market. So you want to follow the direction of the impulse. You want to follow the direction of the volume. Now, by mentioning volume, I'm not talking about volume indicator or whatever. Rather, I'm talking about the volume area of the candles itself. So for the market to move price from this point to this point, this expansively indicates much volume. So if you look at the candles within the past few months, they are not as expansive as this one. And then you see this whole expansive candle to the upside and a follow-up candle. You assume that this market is on a buy program. Now, what do you do as a smart investor? As someone who wants to be profitable? Now, your best bet is going to be hanging around the open of this monthly candle or below it for buys. The reason is because you want to buy at around average price or below average price. So if you are buying below average price, you are buying a discounted market. Please mute your microphone. If you want to buy from close to the open of the monthly candle or below it. Close to the open of the monthly candle or below it. Now, it's likely going to depend on the kind of trader you are. If you are that kind of long-term trader who will trade for a few months or for a few weeks, fine. You want to know which of these concepts to actually apply. So I'll be breaking it down to the daily. Fine. Now, why am I encouraging you guys to actually anchor your trades around the opening price of the monthly? The reason is simple. The large institutions, they use algorithmic systems that key off the monthly and weekly prices. So if the institutions want to deal, they will be likely looking at areas like this. These opens, these monthly closes and opens. They deal in bulk volume. They deal in specific times. So they are not just there trading 24/7. They're not just there driving the market to every direction. Rather, they key their trades, they key their decisions to specific points. And one of these points, which we know very well, are such regions. the monthly and the weekly opening prices. So since they drive a lot of volume and can influence the direction of the market, we want to do well to mimic their actions in selecting our own buyers. So if, for example, let me break it down with this current month. Where is the current month open? Here, this price level. This is this current month opening price. Now, what I mean by keying your trades around or below it is this. Now, let me expand it to a lower time frame. I'll jump straight ahead to the daily and mark January from its beginning. This is the first candle of 2022, Euro USD. Just like I said, the institution, they use algorithmic system that key off at the weekly and monthly opening prices. So where is our monthly opening price here? It's this candle, the open of this candle. So a bearish candle, this is the open. Here we have the opening price for January. Now, just like I said, you want to key your trade around or below the opening price if we are bullish. Now, realizing that this is the opening price, and let's assume that you're a long-term trader, you like to position yourself in a trade and hold the trade for maybe several months or several weeks. This is how you want to be looking at the monthly time frame. So the moment we open, and you've seen that we are in a bullish trend, so what you'll be looking for is validation to continue the bullishness below the monthly open. Now, what is one of the validations we have here? Some of you might be familiar with the concept of liquidity. Now, just looking at this is the monthly open, and we have sell side liquidity here, all of these lows residing below the monthly open. Now, if you've been studying smart money concept for a while, you will likely know that before major rallies, markets will likely take out sell side liquidity. That is what is assumed as a support zone. The retail support zone, market will likely take it out before it will let out itself to rally. So this is something very similar to that occurring in Euro USD. We have something like a support zone. We see the sell side liquidity. Now, we do not want to rush. If you're analyzing off the monthly time frame, you do not want to rush yourself into it. Rather, you want to wait for the market to trade below the monthly open or any PDRA below the monthly open or around it. Now, look at this. This is the monthly open, and what do you have as a PDRA that market trade below for you to actually start sorting for entries? We have this one here, the sell side liquidity. So let me label them so we don't mix them up. So what we have here is the sell side liquidity, which was from here. Here, all of these relative equal lows, they form the sell side liquidity, which is typically retail support zone. Fine. And this is the monthly open for January. So that is the monthly open. So from the theory I'm giving you guys, go on and backtest it by yourself and go on and execute trades on it if you're convinced on it. Fine. So just like I said, if you are the trader looking at the monthly, you want to key your trades around or below the opening price if we are bullish. Now, below the opening price of January, what is there? What is a PDRA you can actually use to focus more on the market to know when to station yourself in the long-term position? It was this one, this sell side liquidity here. So you see markets trading below the open, coming here to take out the sell side liquidity before this rally. This is a fractal pattern. It is more like a repetition. It happens many of the time, most of the time, across time frames. You just want to know where to key your trades on, when to trade. It's as important as knowing how to trade. It's the monthly. We had, let me take this with the replay. You have your month, your new month open this way. When you have it open this way, your focus is to, if you are bullish, your focus is to trade around or below this monthly open. Now, in this scenario, we have sell side liquidity here. So this becomes your target to trade below from. So you want to see market take out this section. Why? Why do you want to see this? Because this is area where the retail trader will accumulate their sales in. So this provides liquidity for the smart money, and they will just come wipe out zones like this, your support zones. They will wipe them out before letting the market to rally. So when you are bullish and you want to jump into a bullish trend, you look out for something like this. Before a major upside move, you see market taking out the retails out of the market. So that is why for some people who trade maybe the basic support and resistance concept, they'll tell you, I was right, my bias was right, but the market took me out and continued toward my direction. So you want to avoid such occurrences, allow the market to do such, take out the liquidities below the support and resistance zone, which are the relative equal highs and the relative equal lows. And in this case, we have this one, allow the market to take it out, which is also a confluence below the monthly open. This is the monthly open, allow the market to take out the liquidity before you become bullish, before you join the bullish side of the market. Now, why are we joining the bullish side of the market? Because we already have an ongoing bullish trend with a higher pricing as its target. So that is how you implement the monthly open. And it's still a similar scenario for the weekly open. So the weekly open for itself, it provides, let me switch to the weekly time frame now, because I'm there. The weekly chart provides intermediate institutional bias. So it does not provide bias that contains as much volume as the monthly, but it gives us intermediate institutional bias. So that makes the monthly chart ideal for swing trades or long-term trades and still short-term trades. Fine. So when we are bullish on the weekly charts, we should focus, just like we did on the monthly, we also want to focus on buying around or below the open.